if you allocate 100% of your cash flow to that debt and then an emergency pops up, guess what typically happens? Now you have to go use a credit card to handle that expense at 29%. Or you have to go to AmScot, or you have to go to payday loan, or you have to, take out another loan or something. And so oftentimes we don't think about what can happen in your process of paying off debt in terms of unexpected expenses, and nobody really talks about how to deal with that, right? Other than have an emergency fund. But what if your emergency fund still doesn't cover the unexpected expense? What are you left with? Ask for money or go borrow, right? Most people don't know how to ask for help, and when they do, they'll maybe not get enough, okay, or maybe not in time. When you borrow, it's more readily available and accessible. Now it's just a matter of how can I effectively and efficiently borrow this money and pay the least amount of costs. And I would argue that with a line of credit, credit card, HELOC, PLOC, those types of tools, you can control and reduce the interest faster and more efficiently. Hope this was very valuable to you. For those that try to explain this to your family members, those of you that get in, say, arguments in the comment sections with others that may disagree. And this is me just saying, like, I actually agree with many of the naysayers of this particular concept, because it's like an illusion, right? It's like this magical thing, this velocity banking thing. Like there's nothing additional going on here. You're just simply replacing the function of your checking account using one of 4 products: credit card, HELOC, PLOC, BLOC, or all of them in your personal finances, and you're speeding up the rate at which money moves, and you're reducing the interest costs faster because of when a payment gets made. So oftentimes what will happen when we try to run comparisons, right? So I'm going to erase this and show what a lot of people do to really discredit, the strategy. Velocity banking is what they'll do in their Excel calculator or whatever is they show let's say we're dealing with extra payments of $1,000 and we're going to try and pay off a car, right? We got a car loan, and the car loan is $400 a month. Is the monthly payment at a 7% interest rate, and we're gonna make extra payments of $1,000. When you run it through a scenario of a calculator, the problem that you'll have out the gate is it's not gonna be accurate unless you get one of those calculators that show the exact day that the money is being applied to the car loan. So let's just say the car loan due date is the 1st of the month. Say it's the 1st of the month when it's due, and the statement balance would recalculate the loan for the next month. Let's say that statement balance comes out, say, after the 5th, right? So due date's on the 1st, and by the 5th you know what your payment's going to look like the next month. Depending on when you apply this 1,000 will affect how that 1,000 gets applied. A lot of people don't know this. So when you make, let's just say I'm in January of recording this video, 2024, when I'm recording this video, and let's say February is my due date for the car, and I have all my bills and expenses, and by January 31st is when I will see this $1,000. That $1,000 will get, say, applied to the due date plus the 400. Well, obviously the first 400 gets satisfied. Interest gets charged off of how that payment is set up on the amortization schedule. Regardless of this $1,000, it's not going to change that $400 payment and the interest costs. It's already been set because the month prior, after the 5th, they already tell you what the payment's going to be on your amortized loan. So it's a fixed payment, of course, but the interest is already going to be applied unless this $1,000 payment is made before the next cycle occurs. That's how you can manipulate and change what that net interest will be. So for whatever month that you're in, it's not going to change how much interest comes out of that $400, but the next payment, it will. It'll have an influence on the next payment being March. This creates somewhat of a difference in how we pay interest. And then it also, again, typically people will have this extra cash flow way after they've already made the payment to the loan, which is typically the end of the month. And by then, they already have the next payment coming up. So on that day, people are, making a payment, and then they make an extra payment. Now, the other thing we have to realize is sometimes that extra payment doesn't get applied till a couple days later. Again, it's gonna take time to readjust for the following payment. It's kind of weird, but that's a slower way of paying the debt down because of how it gets applied and when and how it gets processed. But with a line of credit, it is instant. So in a line of credit, right, let's say we moved the car loan into the line. When I make that $1,000 payment, it instantly shows up, right? So if we owed $10,000, the minute I transfer $1,000, it immediately registers, especially if you're banking at the same bank that your line of credit's at. So if your checking account is at the same bank as your line of credit, and that's where you send all your income to, you can get this instant change, and that'll instantly readjust your daily periodic cost. So instead of paying interest on $10,000, now you're only paying interest on $9,000. And because you're no longer paying that $400 payment, now you're at $8,600, where now you made the payment 100% principal as opposed to interest. Then what happens is only on the due date of the line, interest gets charged. And interest can come out of the line of credit itself. I don't have to make an additional payment to the line. The interest can come out of the available credit, which would just increase the balance. But by then, I'm already sending my next paycheck. So all we're doing is increasing the speed at which money moves, replacing the function of the checking account, and doing our very best to reduce and offset the interest costs. Again, does this work 100% of the time? Absolutely not. It's simply a math equation. All you have to do is find out the daily periodic rate, and then you would basically be calculating the cost of interest every single day in a month, and that'll give you the adjusted total interest cost. Then we calculate, okay, how long does it take me to pay off this lump sum or chunk payment I just made toward that debt? If I pay off the debt, right, then I removed all the interest that was left on that loan. Now what's key is to make sure that you don't pay the same amount of interest over here in the line, if not more. Then that means that didn't work. You didn't do anything different. You didn't increase the velocity of money there. You didn't do anything. But if you move debt from there to here, and now you're at a lower interest rate environment, which means lower cost, and you paid it off sooner, then you save a massive amount of interest. Now what helps is running a scenario of making these extra payments, but also recognizing when that extra payment is being made. Is it being made at the end of a month going into the new month? Is it being split into 3 payments? Maybe you get 3 checks in a month or 2 checks in a month, and every check you're just making an extra payment, right? You could even make the argument that the person that makes an extra payment of $500 sooner than the person that makes a $1,000 payment. Like if we broke up the $1,000 into 2 $500 payments, and those $500 payments went out the moment the person got their paycheck, they would pay their car off sooner than the person that waits till the end of the month until they know how much money's left over, right? And then makes the $1,000 payment. That $1,000 is not going to be as efficient as the 2 $500 payments. It's all about speed. The faster you make those extra payments, or the faster we make these chunks, the faster you're going to get out of debt.